Welcome to the webinar, Mass Customization versus Mass Production, Thoughts on the Future of the Investment Management Industry, featuring Lionel Martinelli. My name is Dave Kramer, and I'm a director within Yale's executive programs. You may be wondering why a Yale director is introducing Lionel, an EdTech Risk Institute management faculty. Well, over the last 5 years, Yale has partnered with EdTech Risk Institute in offering an advanced risk and investment management certificate program. The target audience is you, portfolio, endowment, pension fund managers, product developers within the financial institutions, and ultra high wealth managers. This is a 3-seminar series which will go into a little more detail at the end of the webinar. Today, the focus is on the future of the investment management industry, mass customization versus mass production. In a moment, I will introduce Lionel. However, before I do that, I want to give you guidance on the webinar technology, the controls, and your role. At the bottom of your screen, there are 2 buttons. There's a Q&A button and a chat button. Please press if you have questions, please click on the Q&A button and then pose your question in writing. All right. I will then field those questions and then send them over to Lionel as we carry on the presentation. The chat button is being used for technical questions. So any kind of thing where you may be having where you can't hear properly, or it's breaking up, or you need to understand something technical detail of the Zoom technology. Your role is definitely to engage. This is a live session, and it really gives you a chance to speak and interact with Lionel, who's a leader in this field, and definitely someone that has some interesting perspectives on the future of the investment management industry, something that's affecting you personally. So definitely engage on that. Now, let me introduce Lionel. He's a professor of finance at EdTech Business School and the director of the EdTech Risk Institute. Lionel holds a master's degrees in business administration, economics, statistics, and mathematics, as well as a PhD in finance from the Haas School of Business, which is at the University of California at Berkeley. Lionel himself, I would say, is a Renaissance man. Besides being an exceptional skier, windsurfer, and triathlete, he also earned an additional PhD in astrophysics from the University of Côte d'Azur. More relevant to you, though, is that he's a former member of the faculty of the Marshall School of Business at the University of Southern California and has been a visiting fellow at the Operations Research and Financial Engineering departments at Princeton University. Lionel is a member of the editorial board at several journals, including the Journal of Portfolio Management, the Journal of Alternative Investments, and the Journal of Retirement. He conducts active research in a broad range of topics, including long-term asset allocation decisions, equity and fixed income portfolio construction, risk management, and derivative valuation. His work has been published in leading academic and practitioner journals and has been featured in major European and global journals dailies such as the Financial Times and the Wall Street Journal. He has co-authored reference textbooks on topics related to alternative investments, strategies, and fixed income securities. He has co-authored additional materials too. Lionel has also served as a consultant for various institutional investors, investment banks, and asset management firms on a number of questions related to the risk and asset allocation decisions, and is a regular speaker in seminars and conferences on these subjects. Please welcome Lionel Martellini. Lionel?
Thank you, Dave. Thanks for this introduction. Thank you for your kind words. It's a pleasure for me to be with you today and to share these moments and also to share these views about the future of the investment management industry. And as Dave has said, I definitely would welcome and enjoy the feedback and the interaction around the discussions that we are going to have. It's going to be a brief discussion about 2 main themes. So first of all, as an introduction, I would like to talk about what we can fairly call by now an industrial revolution, which is actually happening in investment management, which is pretty exciting because it's just history in the making. It's happening as we speak. And then I'll move on to the 2 main aspects of any industrial revolution, which are mass production and mass customization. And I'll share a few thoughts on those questions from our perspective. As concluding comments, I will also discuss and make a few statements about the last remaining piece of the puzzle, which is the mass distribution challenge as well. Okay, talking about revolution, I think it is fair to say that after many decades of relative inertia, we definitely have reasons to believe that something big is happening, and a major change is happening in the investment management industry. And we have reasons to believe that it is a change for the better. By a change for the better, I mean that we are looking towards the emergence of welfare improving, cost-efficient investment solutions. And the investor-centric framework that is trying to emerge makes it actually more consistent with investor needs than the product-centric framework that we've been living with for a while before. So these two aspects are critically important. The first one is mass production. On the one hand, it's obviously fair to say that mass production is something that has always taken place in investment management. And if you think about the mutual fund industry, it's all about mass production, right? So having portfolios managed collectively for the benefits of many individuals, potentially, each one of which is relatively small, but the collection of these individuals make it meaningful for asset managers to manage these funds. So what's new is not mass production per se, but what's fairly new is the focus of mass production on the production of cost and risk efficient access to rewarded risk factors. So this is something that I would like to comment on the, in the next section. The next step is mass customization, and mass customization is definitely a key challenge. The mass production of the building blocks is just a starting point. Any one of these building blocks, let's call them smart factor index, for the lack of a better term that has become the accepted terminology by now. Each one of these smart factor index, as useful as it can be, cannot claim to be per se in itself a meaningful solution to any one of our problems as investors, talking about both institutional investors or individual investors. So we need a technology, or we need a framework for then taking all the pieces together and doing the mass customization, meeting the mass customization challenge, which is designing a portfolio based on these building blocks that will, meet our goals. And these goals are different for different investors. Now, I'd just like to mention that these very important changes are actually taking place at a time when the entire world, and also by coincidence, the investment industry are also impacted by two major revolutions, as we all know. The first major revolution is the digital revolution. And I'll say a few words in the conclusion about how the digital revolution might actually play an important role in this, development of mass production and mass customization in investment management. There's also, as we all know, a very important revolution, which is the understanding that the environmental challenge is looming and is coming on us pretty fast and pretty strong. And that has lots of significance, as we know, on investment decisions. But this is a topic that I'm not going to be describing and discussing tonight, even though it's an extremely important topic related to green investing and socially responsible investment decisions. Okay, so let's move on to mass production, the rise of smart factor investing. Well, let's start with factor investing and then we'll talk about smart. Okay, so factor investing is an extremely simple and extremely meaningful concept. There's a very good analogy which was put forward by one of our colleagues, Andrew Ng. Andrew was very eloquently explaining how, factors are to assets what nutrients are to food. So the best way to think about it is when you think about a piece of food, what's meaningful for you or what's important for your physical health is not the food itself, the piece of food itself, but it is the nutrients behind the foods. The proteins, the minerals, the lipids, the vitamins, all of these smaller things that are underneath. And what's important when we are told to have a well-balanced diet is not to pile on, fat and sugar, obviously, which is not necessarily good for our health. But we've got to be mindful that if we only look at, food at the food level, it's not obvious what kind of exposure to the underlying nutrients you eventually going to get. Well, this analogy is actually telling us, what's taking place when we make investment decisions. So making investment decisions in terms of multiple asset classes is something useful, and we feel that we achieve diversification through bringing in, stocks, bonds, but also alternative asset classes like, commodities and private equity, real estate, hedge funds, and other forms of investments in our portfolios. The problem, though, is it is only if we're able to measure and control the underlying factor exposure that we can understand if our portfolio is truly diversified. So to make a long story short, it has often been encountered situations where a seemingly well-diversified portfolio of asset classes was actually a heavily concentrated portfolio of underlying factor exposures. So this is the reason why thinking in terms of factor is extremely important. Well, here is the big innovation in terms of factor investing. We've been using to thinking about the factor exposure in terms of measuring portfolio risks for a long time now in investment management. What's happening more recently is that the factors themselves are becoming the investable building blocks. So the idea is, well, forget about the thousands of securities. Think about the factors as building blocks, as investable building blocks. And so what's happening now is the industry is globally making those factors investable, and those investable factors are becoming available as building blocks and sometimes extremely easy to trade in the format of funds or ETFs and very easy to buy and sell. So that's a profound paradigm shift from thinking in terms of asset classes when framing the allocation decisions to thinking in terms of underlying factors. Now, even though the concept is very simple and extremely meaningful, implementation, as always, is a little more complex. I think it's fair to say that the implementation is pretty mature in equity markets, and I'll spend a few more minutes talking about how it translates in equity markets, how the concept translates in equity markets. On the other hand, it's fair to say that beyond equity markets, there's more work to be done in terms of making those factors, identifying the factors in the first place, and then making them investable. I mean, the big new frontier is clearly fixed income markets and also harvesting risk premia in alternative markets as well. And this is something that we may come back to in the conclusion. Okay, well, let me say a few words about the equity markets, which is a place where we think we have a pretty good understanding of, or a fair understanding of what's going on. Okay, well, so the starting point is the fact that cap-weighted indices like the S&P 500 index, for example, are used by passive and active portfolio managers and also asset owners as benchmarks. But the problem is these benchmarks are ill-suited for the context of efficiently harvesting all of those risk premia that we're talking about. And it turns out that cap-weighted indices actually suffer from two main limitations. And those two main limitations are pretty severe, and they eventually translate into inferior risk-adjusted performance. I mean, to make a long story short, the problem is by using a cap-weighted index as a benchmark, we leave half of the risk premium on the table. So we could get much higher reward for the kind of risks we are taking. Okay, so I was talking about two shortcomings. Shortcoming number one shortcoming of cap-weighted indices. Well, they tend to be poorly diversified. So in other words, they tend to contain an excess of unrewarded specific risk. And this is due to a strong concentration in the largest cap stocks. I mean, if you think about there have been extreme examples in the past where, for example, in Finland, a few years ago, back when Nokia was a strong company, Nokia was more than 50% of the Finnish stock market. So all of these Finnish pension plans were trying to hold the market in the attempt to have a well-diversified exposure to the Finnish local stock market. Well, essentially they were holding 50% of Nokia. And then 25% more was companies doing business with Nokia. So what that implies is that their portfolio, their equity portfolio was not well diversified. And we know what's wrong about ill-diversified portfolio. What's wrong about it is these ill-diversified portfolios contain unrewarded risk. And this unrewarded risk, of course, manifested itself and hurt them when Nokia eventually turned out to be on the losing end of the smartphone revolution, if you will. But broadly speaking, one needs to pay attention to eliminating as much unrewarded risk as possible from one's equity portfolio. So that's one problem with cap-weighted indices. They tend to be fairly concentrated. The other problem with cap-weighted indices is not only they are concentrated, but they are not necessarily concentrated in the kind of stocks that you want to be overweighting in your portfolio, if any. Well, as we know by now, academic research has shown that value stocks outperform growth stocks, that small cap stocks outperform large cap stocks. We call that the value premium and the size premium. Now, in addition to value and size, there are other factors like momentum, low vol, quality that have been found rewarded useful factors in equity markets. Well, if you think about the first two factors, the Fama-French well-known value and size factor, well, the cap-weighted index by construction will overweight the growth stocks and the larger stocks. So in other words, if you're holding a cap-weighted index as a benchmark, you're holding an implicit short exposure to the value premium and the size premium. So you're not going to be receiving the value premium and the size premium. You're going to be paying the value premium and the size premium. And all this is going to happen without you even knowing it or necessarily paying attention to that. Now, it's not like we should blame cap-weighted indices for not being efficient, risk-efficient benchmarks. Well, they have never been engineered to generate an efficient harvesting of risk premium. The problem is just that we might be a little lazy when we use them as default benchmark. So maybe we should do more, and that's what factor investing is all about. So there has been this trend to go from lazy beta, which is factor exposure using the default benchmark, the cap weighted as a default benchmark, to smart beta. Now, smart beta is a marketing term that's becoming a little confusing these days. Everyone does smart beta now. Well, let's take a step back and think about what smart beta actually means. Well, we've seen different waves of smart beta. The first wave of smart beta was a focus on shortcoming number one. So people saying, well, as opposed to using a cap-weighted schemes, we should be using an equally weighting scheme. We should use a global minimum variance, equal risk contribution, or some phenomenal weighting schemes. So thinking about a better weighting schemes for having a more balanced or better diversified portfolios. And the focus there was to try and diversify away some of the unrewarded risk. Now, the problem with these so-called smart indices, as we call them, is that they, in turn, suffer from their own factor biases. So what I mean by this is that every single weighting scheme, and not only the cap weighting scheme, will come with its own implicit set of underlying factor exposure that we may or may not like, just like cap weighted at an exposure to growth and large cap. So there has been a further recognition that what we should do also is actually identify the kind of risk exposure as investors that we want to be holding, and then trying to get an access to this risk exposure. This is called the factor index, or better, the smart factor index. So the smart factor index is essentially a very simple concept that has been, that can be explained in very simple terms. There's this quote that I like a lot from Eugene Fama, who's at the University of Chicago and has been awarded the Nobel Prize in economics for his work on different things, including efficient markets hypothesis. Now, what Eugene Fama says, he says something very simple. He says, all we say in finance is hold diversified portfolios along whatever tilt you choose. Now, by tilt you choose, what it means by this is factor exposure that you choose. So, harvesting risk premia in principle is a very simple process. First, you pick and choose the factor exposure that you want to hold. Maybe it's value, maybe it's size, maybe it's momentum, maybe it's low vol. And then you hold a well-diversified portfolio, also known as smart portfolio, of these factor tilted stocks, so as to eliminate as much as possible of unrewarded risk, so that as much as possible of the remaining risks is rewarded in your portfolio. Just a simple table that shows the benefits of smart factor investing, if you will. Well, the starting point is the S&P 500 index, in this case, in a long period of time, something like 50 years period of time. The Sharpe Ratio is 0.41, annualized return 12%, annualized volatility 17%. Well, this is the good old, S&P 500 index. Now, if we turn to selecting half of the stocks, it's a very simple scheme. We select 250 stocks out of the 500 according to a given factor tilt. So the smallest one for the size factor, the past winners for the momentum factors, the lowest vol for the low vol factor, and the most value stocks for the value factor. And what we find is if we hold a cap-weighted portfolio of these 250 stocks, we get a better Sharpe ratio for all of these tilts. Now, obviously, this is not due to better diversification, right? Because we are only holding 250 stocks as opposed to 500 stocks. Plus, we're holding them in a cap-weighted way. So this is simply the benefit of harvesting a risk premium, which is a size, momentum, low vol, or value risk premium. Now, the next step is we are moving on to a smart weighted version of the same 250 stocks. And what we find is a further improvement in the Sharpe ratio. And that further improvement in the Sharpe ratio comes from the fact that through the smart weighting schemes, through better diversification, we have been able to diversify away a bit of unrewarded risk. Okay, so in closing on the mass production side, the good news is those smart factor indices are now available as building blocks, and the largest and most sophisticated asset owners in the world are now using them as pieces of the puzzle, as underlying building blocks that they are going to use for building up their portfolio.
Lionel,
yes.
I have the first question, all right? And it kind of ties both your paper and also your presentation so far. The question was, in your paper, you mentioned that the shift to factor investing removes or reduces the need for manager selection in portfolio management, all right? But when as you show this, why is this less complex or less of a need for a manager or manager skills?
Okay, yeah, that's a very good question. Historically, if you think about most of the process that an asset owner, like let's say a large pension fund, was going through, was this very complex set of decisions in terms of hiring and firing managers. So you hire managers, you monitor the manager, you fire them, you use consultants to help you fire and hire managers. Now, we have reasons to believe that from a statistical standpoint, it will take something between 50 years to hundreds of years before you can assess whether a given manager is statistically, whether value added by the manager is statistically significant or not. So in other words, the business of hiring and firing managers was somewhat of a distraction with respect to a much more important task, which is, well, what is the set of factor exposure that we need to be holding in the first place? So increasingly, indeed, the focus on manager selection and monitoring is shifting towards a focus on analysis of the kind of factor exposure that we want to hold. And once we come to a decision with respect to the factor decisions that we want to hold, then the next question is what kind of benchmark, what kind of factor index do we want to be using? But these factor indices are much fewer with respect to underlying managers. And then they can be implemented in a passive way, in a very straightforward manner, and at a cost which is actually becoming extremely low. So again, I guess the focus here is as opposed to be thinking about individual securities, which are very many, and individual managers, which also are very many, as building blocks, it has become a little more efficient to think about very few investable indices or factors as building blocks.
Okay, second question too, Lionel. One more, I apologize. Yep. But related to basically the risk calculation, right? You're using the Sharpe ratio, obviously, to kind of explain the risk factor. Could you discuss the Sharpe ratio versus the information ratio and the view of a better risk-adjusted measure?
Yes. Okay. Well, the Sharpe ratio is a standalone measure of risk-adjusted performance that tells you what's the reward per unit of risk that you can expect. And as we've seen, if you go with a smart factor index, and even better, a combination of these 4 or more smart factor indices, well, then you're going to get a better Sharpe ratio. Now, if you start from scratch and you decide that the cap-weighted index is a lousy starting point, that you don't want to look at it, you don't want to use it as a benchmark, well, then this is the way to go. You should think about what's the risk-adjusted performance of your portfolio. Now, this is a very bold move, and most of the asset owners that I'm talking to, they are still looking at the at the cap-weighted index as a reference, and that is actually meaningful because the cap-weighted index is telling us something about the aggregate investment decisions by the market as a whole. So in this latter context, people have found it useful to actually look at information ratio, which is giving us a sense of risk-adjusted performance, but relative to the cap-weighted benchmark. And what we find is we can actually get to extremely high and attractive levels of information ratios using these smart factor indices. And these ratios can actually be further improved when you combine the 4 factor indices in different ways, which, I don't want to comment. We don't have time to comment upon now. But clearly, this is the place where smart factor investing is blurring the line between passive and active portfolio management. So it's value add portfolio management with respect to cap-weighted indices, and that comes at the cost of of passive portfolio management.
Okay, thank you.
It's a big change. It's a very big change. Okay, well, but then the next step is, well, let's assume that we have these factor indices available or some other building blocks, more or less efficient, available. Now, the next question is, how do we package these building blocks in such a way that we eventually come to an investment solution? So if you think about like the car industry, right? So we are producing parts of the car, wheels and steering and the door and the roof of your car, but each one of these building block is useful as a component of the car, but it's only when the car is entirely put together that it makes sense. And we know what happens in the car industry, right? None of us get a fully customized car, but at least we can mass customize, or the mass customization allows us to get the kind of cars that we want or the kind of cars that we need, right? So if you want a small car because you're just alone, then you can get a small car, a bigger car if you've got a large family. If you enjoy going skiing, like Dave and I, you take like a car that can drive on the snow. Otherwise, you get a convertible car to go to the beach, right? All of this is feasible. Well, that's the next challenge for the for the investment industry, mass customization. Well, there again, the good news is it's happening as we speak. And let me take this opportunity to talk about goal-based investing, which is as big as factor investing in terms of these new investment paradigms that are, reshaping the investment industry as we speak. I mean, again, the concept, just like factor investing, the concept is extremely simple and meaningful. And when you put it this way, it's even hard to understand why it's such a new thing, right? It sounds like, this is tautologically meaningful. Goal-based investing only says that the starting point of an investment process should be the client's problems or their goals. So we shouldn't think about investment products. We should think about investment solutions. And for an investment solution to be meaningful, it should, meet the needs of, asset owners, right? Otherwise, it's meaningless. So in a goal-based investing process, we help asset owners talk about their goals, their objectives, if you will, and also, of course, their constraints. And then we put in place an investment portfolio which is dedicated not to be good in absolute terms, not to be good for everyone, because something which is good for everyone is obviously good for no one. But we are going to put together a customized or mass customized investment solution which is suitable to the specific needs of the investor or the set of the class of investors that we're talking to. Well, this is actually, even though it's very simple and straightforward, it's actually a major shift with respect to, modern portfolio theory, right? Efficient frontier kind of portfolio optimization. I mean, this technology is now 65 years old. It started with, the paper by Harry Markowitz in 1952. And even though we keep calling it modern portfolio theory, well, it's like old-fashioned portfolio theory by now. So what I'm saying here is the kind of technology that we're using to construct well-diversified portfolio, which we talked about, right? Minimum variance, risk parity, all of these improvements of, old-fashioned portfolio theory. All of this is only one piece of the puzzle. This doesn't give you an investment solution. We need more. We need goal-based investing. And goal-based investing is actually a comprehensive framework which allows investors to secure their essential goals, these goals that are so important that you cannot afford not to achieve them. And they also, subject to, after securing these essential goals, they also provide us with the highest possible probability of achieving the targets, the aspirational goals, as we call them. And that actually requires a set of technology which is not only diversification, but also hedging and insurance. This is something that we potentially will discuss in the concluding comments. Goal-based investing is a very important move as we see it. It's similar to liability-driven investing in institutional money management. So the good news is in institutional money management, this recognition has already taken place, something like 10 to 15 years ago. And it's happening now in individual money management as we speak again. We don't have too much time. So as I said, the key ingredient in goal-based investing strategies are actually very simple. We need a well-diversified, risky building block. Well, that's the kind of building block we talked about, some kind of smart portfolio smart factor index to give us access to risk premia. So the risky portfolio that we use, we want it to be well rewarded. And then we need another building blocks that we're going to call a safe building block. In technical terms, we call that a goal hedging portfolio. I mean, more often than not, it's some kind of a bond portfolio which is designed so as to match the maturity dates and nominal amount of the cash flow payments that we think in terms of our goal. So if our goal is preparing for retirement, then we're going to match the replacement income cash flows in retirement. So this is very similar to a liability hedging portfolio for pension funds and institutions. And then there's insurance taking place through a suitable dynamic allocation to diversification and to the risky building blocks and to the safe building blocks. I mean, this is the kind of payoff that you get with a goal-based investing strategy. And I would like just to show them for a few seconds and to contrast them with something which is a product. So in this very simple example, we're looking at someone who's trying to secure 80% of some kind of funding ratio. I don't even need to talk about the context, but let's say it's a funding ratio. You start at 100%, and you would like to secure 80% of your current purchasing power in terms of what matters for you in terms of your liabilities or your goals. So 80% is your minimum, but your target is 130. And currently you're at 100%, so you'd like to get to the target. A very kind of optimal goal-based investing process will give you, as we see, a very high probability, something higher than 90% chance of getting the target, which is 130. And when you don't get the target because the markets are very bad, in very adverse market conditions, in those scenarios when you cannot get the target, then you're happy because at least you're securing the minimum. Well, this is a little too good to be true. That's like the optimal ivory tower implementation of the strategy but it's not implementable. It's just what the strategy looks like in textbooks. Now, if you look at what the strategy, the goal-based strategy, corresponding goal-based strategy in the real world, this one is implementable and actually fairly easily implementable. Well, then we see it has about the same shape. So there's a big probability mass around 130. Sometimes you get a little more that you don't need, but that's okay. And then there's another probability mass at the minimum, which is kind of consistent with your essential goal at the minimum and aspirational goal or target at the target level. Now, this is in contrast to existing products like an equity index or a bond index or a balance fund or a target date fund. All of these, as you see, well, those distributions are shapeless. They don't make sense. I mean, they could be good products, but these are only products. They do not do justice to the essential goal of your client, which is securing 80%. Well, there's a big probability that you go below 80%. They also do not do justice to the fact that your client had a target and didn't need more than the target. So you could have done much better in terms of increasing the odds of getting the target. Okay, well, let me just briefly make a few concluding comments. The concluding comments will be on mass distribution. So the good news is mass production is taking place as we speak. Mass customization, well, it's already in place in institutional money management, and it's now happening in individual money management. So the next question we have is, well, when is it going to be feasible for each one of us as individual to get access to these mass customized investment solutions based on these smart factor indices? Is this something that's already available or not? Well, not quite. And there's an interesting development, which is the RoboAdvisor. Just to say a few words about RoboAdvisor, in individual money management, the main cause for inertia is always distribution costs. So distribution costs are very, very high. And it's very hard for individuals to get access to cost-efficient and risk-efficient investment solutions because, well, there's very little incentive for the investment management industry as a whole to distribute them because the fees, you can manufacture them and make them, so inexpensive, if you will, that the fees will not be sufficient for kind of paying the cost of distribution. Well, we all know what's happening as we speak. It's called digital disruption, right? So the RoboAdvisor are now allowing us to get access to to mass customized, hopefully, investment solutions. And it's just, just take your iPhone here, and then you incorporate your goals, and then you click on a button, and hopefully then you get an investment solution which is right for you, and distribution costs have taken way down because this is just digital distribution. This is obviously a threat for existing players. It's also potentially an opportunity for existing players because it's an opportunity to reach out to new clients as well. But it should be an opportunity for investors, for all of us, eventually. Now, I think it's fair to say that we are not there yet, even though robo-advisors are on the rise and we see an increasing number of them. They are still so far focusing on distributing products. And it's not the case that we are able now to get access to meaningful customized investment solutions based on efficient building blocks. But we're getting there as we speak. There's also lots of interesting development with respect to artificial intelligence, but just like for green investing and socially responsible investing, let's keep those discussions for a next opportunity. Dave, are we good in terms of timing?
We're good in terms of timing. Finish up this slide here, then I have one more. I have a comment that's been sent through.
Okay, I just want to take this opportunity then to walk you through the content of this Advanced Risk and Investment Management Certificate program that we're so delighted to run with the Yale School of Management and the distinguished faculty in their finance department. Essentially, the seminar is all about, talking about these very important schemes and developments that we've just discussed. So seminar number 1, which I'm co-teaching with James Choi from Yale School of Management, it's all about multi-asset investment products and solutions. So it's all about, harvesting risk premia across multi-assets and coming into implementation in terms of what we call multi-asset products and solutions. There's also a fair amount of discussion of life cycle investing, goal-based investing, improved forms of target date funds, retirement solutions, and all of these questions. Now, for the first 2 days of this seminar, I focus only on the kind of substantial value that you can add without exploiting predictability in asset and factor returns. And then James follows up with a very interesting discussion on how we can further improve on this, and like icing on the cake, adds the benefits of tactical asset allocation decisions based on predictability in asset and also factor returns. Now, seminar number 2 is dedicated to the most efficient harvesting of risk premia in traditional markets. By traditional markets, we mean equity markets and bond markets. Day 1, day 2, Raman Upal and Will Gottsman, Raman Upal from EDEC Risk Institute and Will Gottsman from Yale School of Management, are talking about smart factor investing and smart beta and advances in equity in portfolio construction in the equity space. And then we turn to Ricardo Rebonato, who's my colleague at EDEC Risk Institute and one of the world leading experts in fixed income. And he's going to talk about harvesting interest rate and credit risk premia. So harvesting risk premia in fixed income markets, which, as we said, is the new frontier. And they have lots of very interesting work which is taking place as we speak. And Ricardo is going to talk about all of these questions. Seminar number 3 is all about harvesting alternative risk premia. So turning to alternative assets, Will Gottsman, who's one of the leading experts on alternative assets, will talk about private equity, hedge and real estate, fine arts, and how they relate to the Yale endowment model as well, and how it has been used by the Yale endowment in the context of their investment process. Gert Hoevenhorst is going to follow with commodities investing, and then my colleague Frédéric Blanc-Breux from EDEC Risk Institute is going to talk about infrastructure investing, which is a very important new asset class in terms of investment decisions.
Okay, so the key point is that this webinar is kind of giving you a taste of the kind of content that would be discussed in our certificate program overall. Right? Obviously, it's a lot more detail there. It's 3 days. Each of these seminars is 3 days in length. So it's a lot more detail in terms of kind of going into these concepts and exploring kind of, I would say, leading edge academic concepts that are really making their way into the marketplace. Excellent program for advanced individuals and for individuals doing, I would say, advanced work in portfolio management, asset management, risk management. All very relevant. The next seminar is going to be in February, and actually it's going to be the seminar number 3, harvesting alternative risk premium. And to turn the page on, Lionel, we'll show the date there too.
So it will be February 5 to 7, 2008.
5 to 7. It's going to be at the Yale School of Management. And this also shows the website to kind of log in and also to register for the program. 2 last things here. One of the participants here is definitely a believer. In fact, he stated that he left his senior MP role at Penn Capital to chase these concepts in the high yield fixed income asset class. All right, so he's looking for I guess advice and counsel and ideally funding too along the way there. The last question though, Lionel, is why the PhD in astrophysics?
Well, that's a good question. Yeah, I don't know. Maybe partly because I'm a little crazy, and I felt like I could use some of my spare time to do things beyond finance. But anyway, astrophysics was a long-lasting love of mine, and you know how it is with your childhood love, right? You keep staying infatuated for your entire life, and you don't know what to make out of it unless you act on it and you do something out of it. So anyway, now I'm kind of also traveling the world and giving talks on from black holes to black holes. And that's also an exciting topic. I mean, there's so much happening in cosmology when we're talking about a revolution in investment management. Well, it's actually nothing compared to how our understanding of the universe as a whole is actually rapidly changing based on all of those recent discoveries and gravitational waves. And I mean, there's so much going on. Also exciting.
Well, thank you.
Welcome.
In closing here, I'd like to thank all of you for participating in the webinar. Essentially, everyone stayed on the entire time, which is a great sign. If you found this interesting, you will find the certificate program very interesting, and the seminars that we host there excellent. So please log on to the website and register for the upcoming program. Look forward to meeting all of you as we host those seminars. Thank you. It's the end of the webinar.
Thank you. Looking forward to seeing you on campus.